to FAME's Wednesday webinar. Today we're going to be talking about federal student loan repayment. I'm Nikki Vachon. I'm a college access counselor at the Finance Authority of Maine. I am going to be your host for today's webinar. I'm super excited to talk about this. This is something I think a lot of people don't know about, so I think it's great that we can get into it. So the college access team, along with our customer service team, who is amazing, are here to help Maine families and students reach educational goals by providing free information on planning, saving, and all things paying for college. So let us know how we can help you. The purpose of this webinar is to get you information about your federal student loan. So we at FAME receive a lot of phone calls from students or parents about borrowing or repaying student loans. Student loan debt can seem like this overwhelming hurdle, but it doesn't have to. Once you understand all of your options, it can feel a little bit more manageable. So that's our goal for today. We're going to find out how to get more information on your loan, like how much do you owe, who are you repaying? I think that's key. What are your options? What happens if you can't or don't pay your loans? Federal loans are so different from any other type of loan, so that's so important. And what kind of loan forgiveness options are there out there that you might qualify? So we're going to dig into all of that. First, let's get your loan information. There's a ton of information at studentloans.gov. To get your personalized information on your loan, you log into studentloans.gov using your FSA ID, so that little login button up top. When you click on that, you're going to put in your FSA ID. Now, the FSA ID is a username and password you created. Maybe when you did your FAFSA, you needed it to get into the FAFSA, or maybe you used it to sign your master promissory note. That's the loan application. You enter it here to log in. If you went to college before 2015, you maybe don't have an FSA ID. That's when federal student aid started using this FSA ID login. If you don't have one, on the right-hand side, there's that Create an FSA ID link. You can click on that there and set one up. But maybe you can't remember. This happens frequently, no judgment. I have a hard time remembering my login information too. I always tell people, try a username and password you use frequently, because a lot of times that's what it is. Or if you can't remember, I just want to point out that your username, you could also exchange that with your email address or cell phone number. So you could enter that instead and maybe that'll work. If none of the above works, there's a forgot username or password link. So you can go there and recover your FSA ID. Excuse me. Once you're logged in, there's a ton of information here. So let's start with, you can see the total amount of loans that you borrowed. And underneath, you can see there's a bunch of resources here. There's apply for income-driven repayment plans or apply for loan forgiveness. So a lot of information there. But below that, you can see detailed information about the individual loans that make up that loan total. So let's click on one of those loans just so you can see. I want to go through what you're seeing here. On this first row, you see direct Stafford subsidized loan. So on the row underneath it, it says direct Stafford unsubsidized. So the word direct is the loan type. In the next slide, we're going to talk more about that. But this borrower has a direct loan. Subsidized and unsubsidized. I want to talk about the difference between the two. So the subsidized loan means that during the deferment periods, the government was subsidizing the interest on this loan for you. So it was paying the interest. This is a zero interest loan while you're in deferment. Unsubsidized means that the interest is accruing the minute you take out that loan. So that's the difference between the two. On that subsidized loan, underneath it, it says SULA eligible. And I just want to point out what that is. SULA stands for Subsidized Usage Limit Applies. What that means is that because this is a great loan, it's you have to become eligible for it by applying for the FAFSA. you can only have a subsidized loan for so long. So you have 150% of the times it takes to complete your degree program. So say you have, you're in a bachelor degree program, that takes 4 years. You're gonna have 6 years worth of subsidized eligibility. So that loan that this borrower took out is gonna count towards that time period. So that's what SULA stands for. Okay. And then on the loan, you can see the amount of loan you received for that payment period. You can see the interest rate for that particular loan. Just want to point out that interest rates change from year to year. The interest rate is determined by Congress. It's based on the 10-year Treasury note, so that's why one interest might be different from the other. You can see the repayment plan that this loan is in. So this lender or this student has a 10-year standard repayment plan. I'm going to go into those repayment plans in a minute. You can see what the status of the loan is. Originated means processed. And then you're going to see the date the loan is scheduled to start repayment or has already started repayment. So that's what that means. Okay, so I mentioned earlier, we're going to talk about loan type. So that former screen, we saw that borrower had direct loans. If you're logging in, you may see that you have a FFELP loan. So what does that mean? Prior to 2010, there were two different types of loans. There was a direct loan and the FFELP loan. Basically the same loan, it's just really depending on who the loan servicer was. Direct loan is directly through the federal government. FFELP loans, that stands for Federal Family Education Loan Program, so through a bank. So maybe you had the option to have one or the other. But after 2010, that FFELP program went away. So after 2010, from then on, we only have for federal student loans the direct loan program. So this is going to be important later when we talk about repayment plans. That may, what options that you have may depend on what type of loan you have, or the loan forgiveness program. That also is where this is going to be important too. So that's the difference between the two. Excuse me. Okay, more about your loan. So I want you to know who you should be repaying. So to do this, we need to drill down a little bit deeper. You're going to click on View Details, and that's going to drill down into that loan. You're going to see a little bit more information about that loan. So where you went to college when you received it, what year you received the loan, the outstanding principal of the loan. So there's a little bit more information here, but we want to find out who you are going to be writing checks to. So if you click on Contact Information, you can see your loan servicer. That's who you're going to be writing checks to. You can see the contact information, the website, the mailing address, a phone number if you need to call and ask questions. I so recommend that you go onto that loan servicer's webpage and set up an online account for many reasons. So you can view your account status, you can make a payment, you can see your history of loan payment, you can communicate with your server if you're having issues, but most importantly, I want to make sure that your contact information there is up to date, because we want your loan servicer to be able to contact you. You know, if you send in a loan payment and maybe they didn't receive it, they may try to contact you to say, hey, your loan is late, but you can say, whoa, I made that payment. So super important. We want, for many reasons, your loan servicer to have your most up-to-date contact information. So good idea to do that. Just want to mention there are several student loan servicers. So when you took out that loan, it was outsourced to one of these loan servicers. So this might be confusing. The loan that we were just looking at was through Navient, but maybe your friend has a loan with FIA and you're thinking, no, we both take out the same loan. Why are we paying different people? Just want to let you know there are several loan servicers. You can go online and see who they are, but I think that's so important, especially when it comes with, there's a lot of scammers out there right now saying, we owe your loan, you need to pay us. I want you to know who you should be working with. So very, very important there. Okay. So this looks like a lot, and I don't want anyone to get nervous. These are all the different loan repayment options, and there's a bit here. I'm going to go over what each repayment plan is about, but then I'm going to show you a shortcut so you can see what repayment plans you qualify for and what your payments are estimated to be. So I'm just going to go through these. So the first plan is the standard repayment plan. So this, when you take out a loan, they're automatically put into this plan. Direct loan, FFELP loan, doesn't matter. Everybody qualifies for this repayment plan. This is a 10-year repayment plan. So that means your payment, the amount you write that check for, is going to be the same through the life of the loan until you get that paid off. So straight up 10 years, that's what you're going to be paying. You maybe didn't borrow a lot of money. There is a minimum loan repayment amount of $50. So say you borrowed $2,000. It's not going to take you 10 years to repay that. So just keep in mind that's the maximum loan term. So if this loan payment plan is not working for you, you can't make the payments, they're too expensive, you have other options that you can change at any time. There's the graduated repayment plan. So this is where your plans start lower and then increase every 2 years. So this plan is ideal for someone whose income is going to be low early in their career and they're pretty sure that their income is going to increase steadily over time. This might be a good option for you. There's the extended repayment plan. So this allows you to repay your loans over a longer period of time. So instead of 10 years to repay your loan, you now have 25. Just want to say this lengthened, the lengthened period of time makes your monthly payment plan lower. So this might make it more affordable for you at the time. First, a warning, it is going to increase the amount of interest you pay over time. So it may end up being, if you stay in that plan, the most expensive option. In the long run, once you finish paying that off, it might be more than other plans, but it might be something that you need to do for a short time period. So to qualify to have this repayment plan, you have to owe at least $30,000 in either a direct or a FFELP loan. So for example, if you owe like $35,000 in a FFELP loan and you have $10,000 a direct loan, you can only choose this for the extent for the FFELP loan because it's over $30,000. The direct loan wouldn't qualify here. If you take out this plan, you have two options for repayments. You have graduated or a fixed amount. So keep in mind, like I just said, graduated means your payments start small and then gets larger every 2 years. Or the standard or the fixed rate, which stays the same throughout the life of the loan. Again, anytime you take longer to repay your student loans, it's going to cost more. So just keep in mind that the longer you're paying interest on a loan, the more expensive it could be. Okay. If your student loan debt is high compared to your income, you may want to look at one of these income-driven repayment plans. So with these repayment options, your student loan payment is based on your income. So it's individually set for you. It's really designed to make your payment affordable. If you can't make your payments, this might be a great option for you. Most federal student loans are eligible for at least one of these income-driven plans. So if your income is low enough, your payment could be as low as $0 a month. I've seen this where your payment is based on how much you make, and it could be $0 a month. And it means you're not making any payments on your student loans, but you're still kept current with them, so it doesn't hurt your credit. You're still in good standing. I just want to say there is an application process with this, so you have to tell your loan servicer how much you make, because remember that payment is based on your income from your taxes or your income from work, or maybe you don't work. You have to apply every 12 months. So just keep in mind, if this is a plan you're going to take, set a reminder for yourself on your phone or your calendar that in 11 months, you're going to, after 12 months, you're going to go back into the standard plan. So if you want to stay in this plan, you have to reapply every year. All right, so let's dig into these a little bit. The income-based repayment is an option for both direct and FFELP loans, but you must be experiencing some kind of financial hardship. The length of time you have to pay depends on when you borrowed. So if you borrowed after 2014, you could have up to 20 years to repay the loan. But if your loans were made before 2014, you could have 25 years to pay. Your monthly payment is also based on when you borrowed. So it depends on when you took out that loan, what your monthly payment is based on. This plan sets your monthly payments at either 10% or 15% of your discretionary income. What does that mean? Your discretionary income is calculated by finding the difference between your adjusted gross income from your tax return and 150% of the annual poverty line for a family of your size in your state. I know this is a lot. I've got a cheat tool for you. Don't worry about it. I just want you to know how this is calculated. But this means that your student loan is individualized to you to match your specific income, cost of living, family needs. Okay, so then there's the pay-as-you-earn repayment plan. This is very similar to income-based repayment, but it's for those that borrowed in the direct loan program. Remember I said the name of that loan is going to count. If you took out a direct loan after October 1st, 2007, the borrower must be in a financial hardship situation. Monthly payments would be 10% of your discretionary income. And it's never going to be more than if you were in the standard repayment plan. So this is going to be a cheaper option. You have up to 20 years to repay this loan. Then there's the revised pay-as-you-earn. You guessed it. This is a tweak to pay-as-you-earn. This really opened up eligibility for income-driven plan for about 5 million more borrowers that didn't qualify before. This plan is open to any direct loan borrower, regardless of when you borrowed. It allows you up to 20 to 25 years to repay the loan, and the loan payment would be about 10% of the borrower's discretionary income. The income contingent repayment plan is for any direct loan borrower. It gives you up to 25 years to repay the loan. The big difference here is that you don't need to provide a financial hardship. Monthly payment would be the lesser of either 20% of discretionary income or what you would pay if your repayment term was in a 12-year plan instead of 10. So it would stretch out that payment a little bit longer, maybe make your payment smaller. So the lesser of those two things. Again, this is designed to be affordable for you. And then there's the income sensitive repayment plan. And this is for people who have a FFELP loan. The loan payment is going to be between 4 or 20% of your discretionary income. It depends on your loan servicer. They get to choose what percent. The payment must be at least what your monthly interest payment would be. You only have 10 years to repay this loan, so lower payments, this is just a temporary option. If your payments are going to get larger over time, and if you think this is now no longer affordable for you, you could consider changing to graduated or extended. So what does this all mean? I know what you're thinking, what does this mean to me? And I told you I had some cheats for you, so I've got this. If we go back to studentloans.gov and you log in using your FSA ID, there's what's called the Repayment Estimator. You log in using your FSA ID, and that is going to preload your student loan amount and interest rates. You're going to select your tax filing status. So when you filed your taxes, did you file single, married, filing jointly, head of household? You put in that tax filing status. You go a little bit further down the screen, you plug in your adjusted gross income, your marital status, number of dependents, the state you live in. That information is all going to be used to calculate an estimated monthly loan payment. So if you can see here, you can see all the repayments and what your payment might be at that debt level that was preloaded for you. You can toggle on this public service loan forgiveness button to on. And what that's going to do is going to show you what your estimated payment would be if you're going to qualify for public service loan forgiveness. And I'm going to talk about that in a bit. But just keep in mind, to qualify for that program, you have to be working for a nonprofit, government, or a government agency. There's a bunch of different qualifying employers. You have to be eligible for that program in order to get that loan forgiveness. I'm going to show you how to do that. but just keep in mind, this is a great way to see if this is something that you're looking to be on track for. It'll show you what your estimated payment is and how much loan will be forgiven. So you can toggle that on. So you can see out of the first 4 plans here, the standard, graduated, and the 2 extended repayment plans, you can see that it says you'll pay a total of over the life of the loan. That's telling you when you finish paying this off, this is how much you will have paid in interest and fees total. That's what you paid out of pocket. Generally speaking, the faster you can pay this loan off, the better. So if you're in school right now and you want to make loan payments, awesome. There's no penalty for early repayment. If you are in repayment and you can make higher than these payment plans, great, go at that. So generally speaking, the less time you have to repay this loan, the cheaper it's going to be because you're not going to be charged more interest. That's why I think looking at each individual plan is going to be great, because I'm all about paying the least amount I can. And that's the name of this game. A lot of people are really focused on how much they can get forgiven. Sometimes you end up paying more in the long run because of the length of time that you're repaying. So just keep in mind, pay this off as soon as you can, and that's going to be your cheapest option. Now, I did want to mention too that if you look down into those income-driven plans, that might be a cheaper option as well, because of the loan forgiveness or because your payments are based on what your income is right now. So just keep in mind, I love to see what's going to be the cheapest option. Now, what if you don't work in a job that is going to qualify for public service, or this is something that is not going to be for you? You can toggle that button to off, and it's now going to recalculate what your estimated payments are going to be. You can play with this website. You can't break it. You can change your income, and it's going to estimate what payments would be. I love using this because it's so individualized. I also want to say that those income-driven repayment plans also have some loan forgiveness when you pay up to the total amount of time allowed in that plan. I'm going to explain this a little bit later, but there is some loan forgiveness. So as you can see, when we toggled off public service loan forgiveness, you may end up paying less in the long run because you got some of your loan forgiven over time. And I'm going to explain this a little bit more, but that's why that might be one of those cheaper options. So more in a bit. Okay. You can click the plus on each one of those repayment plans and see just a little bit more information. So if I chose Revise Pay As You Earn, it's going to show me based on my income, family size, where I live, what my first monthly payment's going to be. So $52 a month. And then the repayment estimator estimates that your income is going to grow over time. So that's why your last monthly payment is going to be higher. Once I finish paying off this loan, it's going to show me the total amount I will have repaid. And because this is a 25 years to the 300 months repayment period, if there's anything left, if I was making those payments every month and after 25 years, there's still a balance, I'm going to have the rest forgiven, meaning wiped out, not paying anymore. More information to come, so hang on to that. Okay, so you're in one of those repayment plans and it's just not working out for you. You can't afford it. You want to switch to one of those, a different payment plan. How do you do this? You can change to the extended or graduated repayment plan by contacting your loan servicer and they'll do it for you. Or if you wanted one of those income-driven repayment plans, on studentloan.gov, there's an apply for income-driven repayment plan. Remember, you have to give them your income information. So this is where you would do that. So it's just depending on what you want to do, you have to go through a different process. Remember that income-driven repayment plan, only good for 12 months. So if you want to stay in that program, you need to reapply every year. Okay, so you picked a repayment plan, you're making payments, and then boom, something happens. You can't make your student loan payments, or you're really struggling. What if you lose your job, or you are injured, or whatever happens? Maybe it's going to take a while to find a new job. The good news is that with federal student loans, there are benefits that you don't have with another loan. So my car loan, if I lose my job, my bank that I took that loan out, they don't care. But with federal student loans, it's different. You have these benefits. There's all kinds of options. So let's go over those. Can you change your loan repayment to a different plan? Remember, that's based on your income. Maybe you go for an income driven plan for a while. So you definitely have that option to change the plan if the plan you're in right now is not working for you. You can ask your loan servicer to see if you qualify for what's called a deferment. So a deferment is a temporary suspension of payments over a period of time. The beauty of this is if you have a subsidized loan, remember that when you have a subsidized loan, the benefit of that is that your interest does not accrue during deferment. So this might suspend those payments. You're not growing your loan over time. So great option if you can't make your payments. Talk to your loan servicer about this. Just want to note that the unsubsidized loan, if you have some, during a deferment, they are going to continue to accrue interest. So you aren't going to have to make payments. You're in good standing with your loan servicer, but depending on what type of loan you have, you either may have your interest suspended or it may still grow. Some reasons that you might qualify for a deferment is maybe you are unemployed, you have extreme economic hardship, maybe you go back to school, you're going to be at least half-time, your loans go back into deferment, or maybe you've been called up to active duty in the military. So that's a deferment. If you don't qualify for a deferment, you can ask your loan servicer for a forbearance. Kind of the same thing as a deferment, but a little different. So you talk to your loan servicer, you request a deferment. This also, again, is you not making payments for a short period of time. Maybe they reduce your payments for a short period of time. In most cases, a forbearance is granted solely at the discretion of your loan servicer, so you may or may not qualify for this. Unlike a deferment, both the subsidized and unsubsidized loans you have are going to continue to grow interest. At the end of the forbearance, that interest is capitalized. Now, capitalization is when the lender adds that interest back into the principal of the loan. So therefore, a forbearance is going to increase the amount you owe. So this is why it's best. It's a cheaper option if you can get a deferment, but if not, there's also forbearance. So to qualify for a forbearance, you might have an economic hardship or maybe an illness. So definitely something to look into. Okay, so there's also the option for consolidation. There's pros and cons to this. So before we make any movement to consolidate, let's pump the brakes. Let's do our homework. Let's look into this. FAME is absolutely glad to help you look into all your options before you do this. I just really want to make sure people know the pros and cons. So some of the pros, if you have multiple student loans, you can combine them into one loan. Maybe if you had a variable interest rate, meaning your interest rate changed from time to time, so sometimes your payments would change and you don't want that variable rate loan. If you take out a consolidation, this is like taking out a loan and repaying all of your loans. Now you have just one loan. So if you do that, you might get a fixed interest rate. Some people really want the fixed interest rate. It opens you up to different repayment plans. Maybe you weren't eligible before. The loan forgiveness program, we're going to talk about that. Sometimes you have to consolidate to get into the steps for loan forgiveness. So this is some pros to why some people might consolidate. Some cons to this. So if you had some benefits with the loan that you had and you consolidate, sometimes they don't carry over into that new loan. So for instance, if your loan servicer gave you an interest rate deduction because you did auto debit out of your checking account, you might lose that. If you had a payment plan that was counting towards public service loan forgiveness, so to do that, you have to have, it counts the number of payments for that loan to count towards forgiveness. Once you consolidate all of those, that pre-loan, those payments don't count anymore. So I just really want to urge people to look into this before you consolidate. Again, this is taking out a new loan, so now your clock is reset. You are extending the period that you're going to owe this loan. So again, more time that you're paying is more interest over the longer period of time. So it could be a more expensive option. Yeah, so this is some cons of consolidation. So definitely something I want you to look into before we move forward. Okay, tips on repaying your student loans. Communicate with your loan servicer. If you're having trouble making repayments, if you're confused about something, if something doesn't seem right to you, communicate with them. If you're like me, sometimes I ignore problems and I hope they go away. This is the opposite of what you want to do with student loans. Ignoring your payments, it can so hurt your financial well-being, and it's really hard to reverse those negative effects. So definitely, I don't want you to go into hiding. Don't go MIA on this situation. Reach out to your loan servicer. They are going to work with you. So if you avoid it, it's considered delinquent, and those delinquent payments are reported to the credit reporting agencies. So those are the people that hold your credit report. It can decrease your credit score. So the next time you go to take out a loan, you might have to pay a higher interest rate. So it's going to be more expensive. So definitely we don't want to hide on this. We want to communicate with our lender. There's so many options for repaying. There's deferment, there's forbearance. We definitely want to communicate. Late fees. Late fees kill me. I don't know if that kills you, but late fees kill me. It's like paying for nothing. Interest is going to build. Your late fees can vary by lender. So for example, you could be paying 6% of your minimum payment on a late fee. And if it's at least 15 days past due. So fees, gross, no one likes those. After 270 days of making no payment on your student loan, you're in what's called default. This is something that is so avoidable, but I don't think people realize what default is. I think they feel like student loans, it's going to be fine if I just ignore this for a while. I just want to talk about what default is, but also that your loan servicer would much rather work out a repayment plan for you than have your loan go into default. So there's a lot of different repayment options. There's deferment, there's forbearance, because default is awful. So what does that mean? When you go into default, your entire loan balance is going to go be due in full immediately. So if you were struggling before, I'm pretty sure you may not be able to pay this whole thing off at once. Outstanding fees and unpaid interest are added to your loan. Collection fees can be added to your outstanding balance. I think this is the killer of this because those fees are super high. It makes it really hard to get out of this default. It makes it really hard to pay the student loan off. So I think out of all of these things, that may be the worst. You might be denied credit, so you might be able not to get a loan or a job. I've had to apply for some jobs where they've checked my credit to see if I have a good credit score before they'd hire me. So definitely something that can hurt your credit and hurt your future job. You can have your paychecks garnished. It means they can take up to 15% of your paycheck. So that means they're going to contact your employer and say, Nikki hasn't paid on her student loans. We need to take some of her paycheck. Tax refunds may be taken. I know I work with some borrowers who are really counting on having that tax refund to live, and then all of a sudden it's not there because it was taken to pay off your student loan. Lottery winnings can be taken. What a bummer. That's awful. You could lose eligibility for federal student aid. So if you want to go back to college, you can't apply for federal student aid. You also won't be eligible for Maine State grant. You can lose those deferment and forbearance options. It can prevent military advancement. You could lose a professional license and you could be sued. This is like someone described this to me like tripping into a vat of acid, and I think that pretty much describes it. It's avoidable. You don't have to do this. We can help you work to avoid this. You can also look at doing any of those other plans, forbearance, deferment, consolidating. There's different options for you. So please communicate with your loan servicer just to not go into this. It's incredibly hard on student loan borrowers who may already be going through something else that they don't need to. So, all right. Back to the benefits of having a federal student loan. So there's also forgiveness programs. I had mentioned this earlier. There's forgiveness and there's cancellation. So if you're a teacher working full-time for 5 complete consecutive years as a highly qualified teacher in a low-income school or educational service agency, there's a ton in Maine. Your first loan is after October 1st, 1998. You could have up to $17,500 forgiven on subsidized and unsubsidized Stafford loan. So forgiven, wiped out, you don't have to pay it, gone. More information about this on studentaid.ed.gov. There's also total and permanent disability discharge. So if you become disabled, you could have your loan wiped out. You don't have to pay it anymore. Just want to say I was listening to a podcast the other day of someone who had a federal loan. They could refinance, meaning they could take out another loan with a bank, like a private loan, get a much lower interest rate. And then later on, that person, it was a really good deal to refinance, but then they became disabled. If they'd stayed in their federal loan program, they could have had some forgiveness, but now it's a bank loan and they can't. So this is a great benefit of having one of these loans. There's also death cancellation. So if you were to pass away, your loan is discharged. Your estate no longer owns this. Your estate would have to provide a death certificate to have this wiped out. But like my car loan, if I were to pass away, my bank's going to go after my estate to still get repaid on that loan. So this is one of the benefits of having a federal student loan. There's also those income-driven repayment plans we talked about a little bit earlier. So if you've been in one of those plans and you've reached the end of that repayment term, the 20 or 25 years, if there's still principal and interest left to be repaid, the balance is going to be forgiven. Wiped out, you don't have to repay this. Just want to note that under current tax law, if your loan is forgiven in this type of forgiveness, it represents taxable income for income tax purposes. So when you do your taxes again, this would count as taxable income. So there's also forgiveness for working in public service jobs. I really want to focus on this because it's estimated that there are millions of people that might qualify for this program, but there's only a small portion of borrowers who have taken the steps to see if they qualify. So public service loan forgiveness, I'm going to call it PSLF because that's a mouthful. This is a program designed to encourage students to join and continue in public service jobs by forgiving eligible direct loans after they've made 120 income-based payments. That's a lot. I'm gonna get into that. So this program was enacted in October 2007. So 120 payments, that's 10 years. So 10 years after this started, October 2017, we started seeing people apply for public service loan forgiveness, and most of them have been denied. They're not doing one or a couple of the things they needed to do to be on track for the loan forgiveness. So let's talk about that so you can see if this is something you might qualify for and how to work at it, because there's stuff you need to do right now. So to be eligible to have your student loans forgiven, that means wiped out, you are not paying anymore, through PSLF, you must have these three things, right? This is the trifecta. You must make 120 eligible payments. Now, what does that mean? Eligible payments are paid on time, so you can't be late, paid in full, in the right repayment plan. I'm going to go into that. And any payments made after October 1st, 2007, that's an eligible payment. Bam, that's going to count towards that 120. On eligible loans, so those payments in the right repayment plan, paid in full on time, have to be made on the right type of loan. So this is for direct loans only. If you have a FFELP loan, it does not count towards PSLF. If you are in public service, if you are in a FFELP loan and you want to qualify for this, you could consolidate into a direct loan. Again, let's hold off on that. Let's do our homework, but that's a way to get into this loan forgiveness program. You need to be making these eligible payments on eligible loans while working for an eligible employer. What does that mean? That's government, not-for-profit, or an organization that is providing public services. So I'm going to get into that. So if you make a payment in the right repayment plan on time, paid in full, while working full-time for a government, nonprofit, or public service agency on your direct loan, that payment is one payment that counts towards your 120. After 120 of those, whatever's left on your loan is forgiven. I would like to point out that in this program, anything that is forgiven is not put on your tax return. It is not considered taxable income. So let's drill down a little bit further into that. What's a qualifying repayment plan? Those income-driven repayment plans, repay, pay-as-you-earn, income-based repayment plan, income contingent plan, those count. But also, that standard loan repayment plan that you were entered into immediately when you started repaying your loan, those count too. Here's the caveat. If you stay in that standard loan repayment plan, after 10 years, after your 120 payments, whatever, there's nothing to be left. So yes, this payment made in that plan does count, but you can't stay in it to get any loan forgiveness. Again, name of the game is what's going to be cheapest for you in the long run, not what you can get forgiven. So that's what a qualifying repayment plan is. What's a qualifying employer? I think this is, people are not quite sure, like they think they might qualify, but I think a lot of people just don't realize that this is pretty broad. So remember, it's who you work for, not what you do, not what your job is. It has to be a government, public service, nonprofit agency. I think there's a lot more nonprofits out there than a lot of people know. So definitely something to look into. So maybe you're a firefighter, maybe you're a teacher, maybe you work for a college that is a nonprofit. Maybe you work as a librarian in a school or in town, or maybe you work at the town office. There's a ton of these. You can get more information at studentaid.ed.gov. I'm going to show you a tool here in a second that's going to help you kind of figure this out. So just realize this is really broad, and I don't think a lot of people realize how broad this is. Again, this is who you work for, not what your job is. I did work with someone who worked in the cafeteria of a hospital. Now that hospital was a nonprofit. A lot of hospitals are. But the cafeteria services were outsourced by a for-profit employer, and that's who she worked for. So she was thinking that she was going to qualify for this because she did work at the hospital, which was a nonprofit, but her actual employer was the food catering service company. So it's just important for you to realize who are right employers. Okay. You're thinking maybe you do qualify for this program, or maybe you're just not even sure. There is a public service loan forgiveness tool. This website has been built. I think this is great information. You log into this website listed below. You log in using your FSA ID, and that's going to preload your loan information. It immediately is going to say either yes or no, you are in the right loan type, or your right loan repayment. You have to fill out some more information. It needs to know who you work for. Is it a qualifying employer? Do you work full-time, which is more than 30 hours, or whatever your employer considers full-time? So you're going to have to answer some questions. When you do that, it starts filling out this employment certification form, which you can print out later. It's going to fill out this form. I want you to do this now. We're not going to wait 10 years to do this. We're going to start doing this now, and we're going to do it every year going forward. So when you get this form, it's going to say, yes, you have the right loan, you have the right repayment plan, but you need to verify your employer is the right type. So it pre-fills this employment certification form. You take this form to your human resources office and they sign off saying, yep, we are a qualifying employer, they work full time. You take that form and you send it to your loan servicer. Your loan servicer will look at the period of time you've worked, and they're going to send you a letter back saying how many payments are counting towards PSLF. That letter is gold. You hang on to that because we're going to need that later to provide to get that forgiveness when we go to apply for it. So start doing this now. Do this yearly. If you're in one of those income-driven repayment plans, you're going to need to do your income, tell them your income anyway. So just do this at the same time. I also want to say, think back. This started in 2007. How many nonprofits, government, public, tribal agencies did you work for full-time and you were making payments on your student loans? Go back to that employer and have them fill out one of those forms too, as well, so that you can get those payments counted toward public service. So that's kind of how this works. What happens next? Your loans are going to be transferred to the only loan servicer that is dealing with PSLF. Fed Loan Servicing is one of those loan servicers I showed you earlier. If your loan isn't already there, it's going to be transferred over. So the person you're going to pay from there on out is going to be Fed Loan Servicing. So it's going to be moved. Some people get confused by that. After you've made your 120th payment on that glorious day, you need to ask for your loans to be forgiven. So there's a form for that. You're going to send this form with your documentation of all the payments that counted. So that's why it's important to start working on this now and start doing this every single year. So important. I think a lot of times the reason why people have been denied for the loan forgiveness is that they didn't realize they were in the wrong repayment plan. They had a FFELP loan. They weren't making one of those qualifications that they could have changed early on in the game and then been done with it. So just, it's great to start working on this now. Don't wait until later. People ask me all the time if I think this program is going away. In my personal opinion, I don't have a crystal ball, but when you signed your master promissory note, it did say that this public service loan forgiveness is going to be an option for you. So you have a contractual agreement for that. So I feel this keeps going up on the chopping block when it comes to budgets. I think that if this program is changed, it'll be for new borrowers. It won't be for borrowers who had signed that promissory note saying that this is going to be a benefit for them. So that's Nikki's opinion. Okay. So what do you do if you have a dispute with your loan servicer? Just wanted to let you know that if for some reason your loan servicer you feel is not hearing you, maybe you made a payment and you think it shouldn't have been late and they think it should and they're not going to do anything about it, there is something called an ombudsman. So the Federal Student Aid Ombudsman is just this dedicated organization to help resolve disputes with student loans. It's a neutral, informal, confidential organization. I've had great luck with. They're very clear. They're there to help you understand maybe why loan servicers do something, and sometimes loan servicers make mistakes. So it's that's an organization that's out there for you. FAME is here for you too. Again, we're a free resource, so we can help walk you through some of this stuff if you are having a dispute with your loan servicer. So let us know how we can help. Okay, coming near the end, bonus round. There are tax credits to having student loans. So there is a benefit, again, to having your student loans. If you live and work in Maine and you're making student loan payments, there's this educational opportunity tax credit that may reimburse you for those loan payments that you made. How awesome is that? When you go to file your Maine state tax returns, you fill out this form to get some reimbursement on this. There's great information at liveandworkinmaine.com where this is laid out. This program has changed multiple times over the years, so there's different qualifications depending on when you borrowed or when you graduated. So go to liveandworkinmaine.com and check that out. Just want to point out, if this is the first time you're hearing about this and you're thinking, man, I missed out on this, you can amend your tax returns back 3 years. So you can go back and claim this tax credit if you haven't. There's also a federal tax credit on student loan interest payments. Excuse me. So you can take a tax deduction for interest paid on student loans that maybe you took out for yourself, maybe your spouse, your dependents. This applies to all loans, not just federal student loans. This loan maybe you took out for higher education. It doesn't have to be a federal student loan. The maximum deduction is $2,500 a year. More information at irs.gov. Just want to say again, if you did not take this tax credit and you think you should have, you can go back 3 years. And finally, just a public service loan announcement. I think the scammers have really ramped up, and there's a lot of companies that are offering to help you with student loan forgiveness or changing your repayment plan. They are charging a fee to do what your loan servicer will do for free. Sometimes they take payments and they're not doing anything, so they're scammers. It's very convincing what they're saying. They're calling, they're emailing, they're radio ads. You don't need to pay someone to help you with your student loan. We here at FAME will help you. Your loan servicer is there to help you. That's their job, to help you through this process. So please, before you give anyone your information or you change your lender, please give us a call or talk to your loan servicer to see if this is legit. They may be offering you a refinance loan. So basically that would be taking out a bank loan to pay off your federal student loan. Remember all those benefits? If you do that, you lose those benefits. We have a website called theloanforme.com where we have a whole section on refinancing. I would urge you to look at the list of things to consider before doing this, because again, your federal student loan has awesome benefits. And if you refinance, you lose those. So there are some benefits to refinancing, maybe a cheaper interest rate. But again, I'm not sure it's going to be worth giving up those federal benefits. So give us a call. We're here to help. Your loan servicers to help. Public service announcement done. Okay, so that is it for me. Thank you so much for staying with me through all of that. I know it's a lot. If you have questions going forward, you can reach out to us, give us a call. We have an email, education@famemaine.com. We have a ton of information on our website, fame-education.com. And check out our social medias. We work really hard to keep those information for you out there, especially information on loan forgiveness programs, repayment plans. But on our YouTube channel, we have these short informational videos that we've created, little animated videos. Like if you don't know how to create your FSA ID, we've got a little animated video to show you that. So check out our social medias. We're here to help you. Please let us know how we can help. Thank you so much for your time today. Give us a call if you need us. Thank you so much. Have a great day.